We have to just jump right in today with the most dramatic event in the market, because while the big stock indices were basically stuck in neutral, silver just absolutely exploded.
Oh, it really did.
It closed the session up a staggering 4.67%. It hit $60.78. That's the first time in history it's breached that $60 level.
Yeah.
An all-time high.
It was definitely the headline move of the day. It brought some, real volatility to what was otherwise a very strange holding pattern for the broader market.
Exactly, a holding pattern.
The major indices were missed. You had the S&P 500 slipping just 0.09%, while the NASDAQ managed to edge up 0.13%. Everything was basically treading water.
Just waiting for tomorrow's big FOMC meeting.
Completely.
And that waiting game is really the core of what we need to unpack today, because the market is sending some truly contradictory signals.
It really is.
On one hand, you have what looks like a near certainty, right? A 25 basis point rate cut tomorrow is priced in with, what, an 87 to 89% probability?
Yep, it's pretty much a done deal in the market's eyes.
And yet, if you look under the hood, the markets were trading as if investors were also somehow bracing for some of the worst possible news for 2026.
That contradiction is the key observation. You've nailed it. Traders are positioning for that immediate good news, the accommodation, but the really important signals from fixed income. They suggested investors are bracing for some decidedly hawkish forward guidance from the Fed.
About the longer-term path.
Exactly. And that tension wanting the cut now, but fearing the commentary about the future, that defined everything today.
Okay, let's start with that Treasury paradox, because I think this is where it gets confusing for a lot of people. If the market is almost 90% sure the Fed's going to cut rates tomorrow, why on earth did Treasury yields rise today?
It's a great question because logically you'd expect them to go down. But today, the 10-year Treasury yield rose 2 basis points, climbing to 4.190%. And the 5-year, it climbed even more. It was up 3 basis points to 3.780%.
So what's going on?
This behavior has a name. It's called selling into the cut.
Selling into the cut. Okay, walk us through that. What does that actually mean for someone who doesn't live and breathe the bond market?
It means bond investors, they believe the Fed will deliver the cut, yes, but they also anticipate that Chair Powell and that updated dot plot will signal fewer total rate cuts for the year 2026 than what the market has currently priced in.
Ah, okay. So it's not about tomorrow's action. It's about resetting expectations for the future.
Precisely.
If the Fed hints that this easing cycle is going to be shorter or, I guess, shallower than everyone hoped, then those longer-dated yields have to rise.
Exactly. Investors demand more compensation for holding that debt if rates are going to stay higher for longer than they thought yesterday. It's pure fear of the future, and it's overriding the excitement about the immediate cut.
And speaking of fear, or at least caution, let's talk volatility. The VIX ticked up today. It rose 1.62% to close at 1693. Is that just more of the same nervousness we're seeing in bonds?
It's not panic, I'd say it's more tactical. It confirms that positioning. What's interesting is that the VIX itself is still pretty low, historically speaking, and the VIX term structure, it's still firmly in what we call contango.
Okay, contango, let's define that.
So contango just means that the expectation for volatility in the future, in this case 3 months out, is higher than the volatility priced in for right now. The spread, the VX3M, is positive at plus 3.15 points.
So traders aren't worried about the next few days. They're buying protection for, what, early next year?
That's it exactly. They expect things to be pretty contained around the Fed decision itself, but they are pricing in much higher readings for the first quarter of 2026 when, the policy path gets a lot murkier. It's a very measured forward-looking hedge.
So if treasuries are signaling caution about 2026, where did investors actually put their money today? The indices were flat, but that must have masked some serious rotation underneath.
It absolutely did. The Russell 2000, the small cap index, was the real equity standout. It showed some aggressive risk appetite.
It hit a new high, didn't it?
An intraday all-time high, yeah. It reached 2,541.77 before closing up 0.21%. That's your clearest signal. Domestically focused, rate-sensitive companies are positioning for that cut.
Because they benefit the most from lower borrowing costs?
Right. Immediately.
But that small cap enthusiasm was just completely absent in the blue chip average. The Dow Jones had the worst day of any major index. It fell 179.3 points. It's minus 0.38%.
A huge divergence. And
Yeah.
that drop was driven primarily by an idiosyncratic risk, which is a really important distinction to make.
Meaning it was a company-specific problem, not a macro one.
Right. JP Morgan, which is a giant part of the Dow, had a sharp decline. I think it was reported to be over 4%, and that was after an executive warned about rising costs in 2026.
Rising costs from where?
Two very modern pressures: intense competition, especially in credit cards, and just massive, massive spending on AI.
The AI arms race.
It's the perfect example of how, even with a friendly Fed, micro-level corporate realities can just drag down the biggest names and overshadow the whole market.
You have to spend billions on AI or you get left behind.
And that spending hits the bottom line. Looking at the broader sectors, you saw energy lead everything with a 0.62% gain. ExxonMobil was a big part of that, climbing 3.4%.
So investors were rewarding visible, clear earnings catalysts.
That's the pattern. They flocked to clarity. And on the other side, healthcare had the worst day, down almost a full percent at minus 0.97. The money today was definitely favoring stability and known drivers.
Let's circle back to commodities, because that's where the day started. Silver's move was historic, but the whole complex was just all over the place.
Extreme dispersion, for sure. Silver led the charge, hitting that all-time high at 60.78. Gold also had a decent day, advancing 0.51% to $4,210.60.
And silver's move really compressed that gold-to-silver ratio down to 69.28.
It is, which is fascinating.
So why is silver outperforming gold so dramatically? Is it all just betting on the Fed cut?
That's definitely part of it, the monetary angle. Lower rates reduce the opportunity cost of holding it. But what makes silver's run so powerful right now is this convergence of catalysts. You have the monetary demand plus incredibly robust industrial demand.
And the industrial side is coming from?
Think solar panels, electric vehicles, and all the next-gen chip tech that's going into those new AI data centers. Silver is, well, it's pretty much irreplaceable in those applications.
So you have a key tech metal plus the Fed easing.
It's a perfect bullish cocktail. And it's why silver has now more than doubled year to date.
And then on the complete other end of the spectrum, you have the total collapse of natural gas.
Yeah.
It fell a massive 7.02% to 457, just a brutal reversal.
Brutal. That drop erased most of the gains from last week.
Yeah.
And the driver here had nothing to do with the Fed. It was entirely specific to the commodity itself.
Weather forecast.
Revised weather forecasts, yeah. The new forecast showed much milder conditions expected through December 23rd, a key heating period.
So one shift in the weather outlook caused a 7% drop.
It's a powerful reminder that while macro dominates the conversation, for individual commodities, simple supply and demand dynamics like the weather can just take complete control.
Got it. And what about crude oil before we move on?
WTI crude was down 0.82% to 58.40. Both WTI and Brent are trading below their 200-day moving averages, which is a key technical level to watch. WTI is actually sitting 8.28% below that level right now.
Okay, let's switch over to currency markets. The focus there was all about global policy divergence, right? And specifically, the pressure on the Japanese yen.
A ton of pressure. The dollar-yen pair, USD-JPY, it surged 1.02% today, up to 156.92.
And that is pushing it deep into what we've called the danger zone.
Deep into it. That's territory where the Japanese Ministry of Finance historically steps in. 155 is usually seen as that sort of vigilance threshold.
And when they intervene, what does that actually look like?
They basically go into the open market and sell huge amounts of US dollars to buy up their own currency, the yen, to try and artificially strengthen it. A yen this week causes real problems for their economy.
And what's so strange is this is happening even as the market is pricing in a 70 to 80% chance of a Bank of Japan rate hike next week.
It's a total paradox. But the rate differential between the US and Japan is just so vast that the carry trade is still incredibly profitable.
Borrowing and cheap yen to invest in high-yielding US assets.
Exactly. And one small BOJ hike just can't overcome that gap right now. Meanwhile, the dollar index, the DXY, edged up 0.16% to 99.25, helped a bit by a stronger than expected JOLTS report.
Right, the job openings data. It showed 7.67 million openings in October, which was harder than expected.
Yep, a little extra fuel for the dollar.
Okay, let's talk about crypto. It seems to be in its own world, completely ignoring all this caution we're seeing elsewhere. Bitcoin gained 2.19% to $93,080. But Ethereum, was the real star.
Ethereum surged. It was up 5.87% to 3,329.92.
That divergence is loud.
It is. Crypto traders seem to be positioning way more aggressively for a dovish Fed than stock investors are. The asset class is so sensitive to real rates, it's just ready to run on any hint of accommodation.
It's a pure real rate play right now.
It is, though we should, note that both Bitcoin and Ether are still well below their all-time highs. Bitcoin is still 26.23% off its peak, but the momentum is definitely there.
Which brings us right back to tomorrow, 2 p.m. Eastern, the FOMC decision. We know the cut is priced in, so what are we actually watching for?
The cut itself is a non-event. The whole show, the thing that will move markets, is the updated summary of economic projections, specifically that updated dot plot for 2026 and then Chair Powell's press conference.
And the analysis suggests the market is leaning towards a less than ideal outcome.
It does. Our analysis points to a slightly higher probability for what we're calling the hawkish cut scenario.
The hawkish cut. So to be clear, that means the Fed delivers the cut, but they also signal that there will be fewer cuts in 2026 than the market is hoping for.
That's the one. The probability for that hawkish cut is sitting at 45%. That slightly outweighs the dovish cut scenario, which is at 40%.
And that 5-point difference explains the nervous selling we saw in bonds today.
It confirms it perfectly. The big question for tomorrow is whether Powell's language can be dovish enough about 2026 to offset the pressure that's already building in the Treasury market.
So if you're trying to make sense of today, what's the final takeaway? You have this weird conflict, silver and small caps hitting all-time highs, while blue chips fall and long-term yields rise.
That counterintuitive rise in Treasury yields, that is the most important clue for tomorrow. It suggests that even with the cut, the actual dovishness from the Fed, the guidance for 2026, it has to be even better than the market's low expectations. If it isn't, you could easily see yields spike higher and trigger a sharp pullback in all those growth stocks that ran up today.
That is the tension that's going to dominate tomorrow afternoon.
Without a doubt.
All right, I think that covers all the essential moves and these contradictory signals we saw today. It was a really complex session of positioning.
It was a very busy day of technical trading and hedging. The market is really showing its cards about what it fears most, and it's not tomorrow's cut, but the path beyond it.
That's the daily consolidation for today. As always, remember, none of this is financial advice. We're here for educational and informational purposes, so please always do your own research before making any decisions.
Absolutely.
But if you found this conversation helpful, go ahead and hit that subscribe button. We're here every day after the close to break it all down.
See you next time.